Hello, everyone. Thank you so much for joining us for another weekly wrap-up. My name is Jeremy Kronemeyer, Operations Manager for Wickham Financial Group. I have Graham Wickham here, President and CEO of Wickham Financial and Insurance Services. Graham, what happened in the markets last week?
Yeah, thank you, Jeremy, and thanks for our listeners jumping in on another call. You got some volatility hit last week. So we saw the U.S. indices basically hit a record high early in the week, and then they gave up the goat pretty much towards the end. But the rally is pretty much driven by NVIDIA, the large cap chip stock, about $4 trillion. So it drives the market. But it had about a $100 billion data center investment, the OpenAI, driving the market. So we saw those gains fade, if you might, towards the end of the week as Fed Chairman Powell flagged some high stock valuations. We also saw Q2 GDP revised up 3.8%. So oddly enough, that's showing that maybe the economy is going to grow quicker, but that also weakened the expectation or reduced the expectation that the Fed may cut more. So we saw the major indices in the week slightly lower. That was less, down about 1% or a little less than that. So if we look at commodities and sectors, we saw gold rise about 2%, and silver took the real lead here. That was up about 7%. Energy and utilities up 4% and 2%. So they were really the leading sectors, or the two most positive. We saw some reduction in Russian oil exports and some Ukrainian drone attacks on Russia energy infrastructure. So that probably put some pressure, that upward pressure on those energy prices. So if we look at U.S. economic data, so we saw the business activity that slowed for the second month. We saw the S&P Global Flash Composite PMI that fell to about 53.6. We saw some weakness in both manufacturing and service, so we are seeing some moderation here. We saw tariffs cited as a main cause of higher input prices. New home sales, they jumped up about 20.5% in August. That was the best we've seen in 3 years. Existing home sales that remained pretty flat, with median home prices still up about 2% year over year, with about 28% of those sales, they were all cash, not financed. So we look at durable goods orders, they rose about 2.9%. And we saw basically goods and trade deficit narrow a bit to about 85.5 billion. Jobless claims, they beat expectations at 218,000, but continued claims stayed elevated. We look at core PCE inflation. That held pretty steady at about 2.9%. So we've been seeing that 3% range for inflation overall, still hovering there, not dipping down to that Fed's rate of 2 that they'd like. We saw the one-year inflation expectation rise to about 4.7%. That was dragging some consumer sentiment down to about 55.1. We look at global highlights. Germany flash PMI improved to about 52.4. That was the best in 16 months. Business climate index, that softened a bit to 87.7. Over in the UK, we saw the PMI dip to about 51 due to some rising labor and energy costs. In Asia, we saw China held rates pretty steady, but Japan's CPI was flat at 2.5 year over year, and Australia's CPI rose to about 3%, reducing some chances of maybe some near-term rate cuts. Now, this week, we're going to be really dialed into some key economic data. We'll be looking at labor market focus. That will be in focus with the JOLTS number coming out on Tuesday. That's job openings. We'll look at the ADP on Wednesday. That's private payroll. What is the health of the job market, if you might? We'll be looking at the non-farm payroll and the unemployment rate and wage data coming out on Friday. Pretty crucial because that could set the tone for the Fed's policy going forward. Inflation watch. We'll be looking at the ISM manufacturing and service PMI, looking at the consumer and wage insights, and that will be coming out with consumer sentiment and wage data. Commodities and energy, OPEC's going to be having a meeting on Wednesday, maybe a supply cut signaling, which could increase some commodity market volatility. We'll just have to see what that impact is and possibly impacting inflation. Now, if we look at some other market drivers, we got an auction in U.S. Treasuries coming out. We'll see the Q3 earnings season starting. Always starts with the major banks setting the tone. We got the Fed commentary, some geopolitical developments. They're always going to be key. Always add a little bit of drama to the markets. And then we'll kind of be wrapping some things up on global economic indicators, like the global PMI, some Europe, some China expectations, diverging market growth. We're just seeing some trends kind of diverging, if you might, within those regions. Yeah, Jeremy?
Gotcha. Well, Graham, I had a question for you. Since the rate cut a few weeks ago, the market's been going a little sideways. What do you see for our listeners as maybe something to watch out for and look for?
Well, I think we got to expect volatility. I'm not going to say generally we're at a low valuation at 22 plus times forward earnings on the S&P. Historically has been high, but it doesn't mean we got to have some major correction or anything, because we're still seeing some reasonably good growth. Maybe some moderation in that growth. We got the Fed lowering interest rates in a reasonably good environment. Unemployment's in check. The consumer's still spending, even though things are moderating. But we said that was going to happen. So they're not lowering rates because, things are falling off the cliff, but they're certainly, not going to be so quick to be dramatic about lowering rates if the economy's still growing pretty decent, which is kind of where we're at. So I would expect volatility, stay diversified, stay the course.
Gotcha. Well, Graham, we always appreciate the information and expertise, and thank you to our listeners checking in with us every single week. And we look forward to seeing you next week. Have a great day.
Take care.